What's going on, guys? I want to talk to you about using inverse funds while you're holding your long positions, whether you're a high yield investor like me, a growth investor, whatever, doesn't matter. I think inverse funds are a great way to make money as the market's going down. What is an inverse fund? Let's just get this out the way. Inverse fund does the opposite of what the market does. So if the S&P is dropping, your inverse fund will rise. If the S&P is rising, your inverse fund will drop. So it's specifically used for me anyway, when I think a pullback, correction, or bear market is coming. They've been a great tool for me through the years. I've used so many different ones through the years. I want to highlight some of these I've used. Now, I generally only specifically go with market-related inverse funds. I'm going to talk about one with IWM or the Russell, one couple I use or have used for the S&P or SPY, and then there's the ever-popular SQQQ for the NASDAQ. So before I get into it, this is Mike, the Tactical Stock Scalper. All right. Guys, inverse funds are absolutely amazing, and I have had great success with them through the years. Now, you have to understand this. With the market generally going up over time, yeah, you may have a down week, month, year, years, right? Whatever. But generally speaking, the market goes up. So inverse funds by themselves are risky for that fact. However, I personally like them better than, say, buying puts. The issue with inverse funds is there is some, it will degrade over time. Much like, I guess you could say, theta on if you buy a put option. There is some decay over time with your option because of theta. Now, why I like inverse funds better, and particularly leveraged ones, is because there's no time. There's no expiration date, right? If you're waiting on a down move and you buy a put and the down move is taking longer than you expected, you have an expiration on your option. You don't have that with the leverage fund. So most seek daily, daily investment, daily investment results, which means they're traditionally used for a day. Well, I have had great results holding them for days, weeks, and months, as long as you manage them properly and you do have a stop loss at some point on these. Every time I use an inverse fund, I do have a stop loss, a hard stop put on. That way, if something ever happens, like I go to the hospital or something whatever, if something happens and I can't look at the market for one reason or another, they won't blow my account up, or, nothing really, really seriously bad will happen because I have a hard stop on them. But I have the stop way up. I use that in case of emergency. I always have a mental stop, but my hard stop put into my platform every time I use an inverse fund. Okay, so let me talk about one of the first ones. Let's talk about IWM. I love to trade IWM going up and down because the thing trades in channels. So in lieu or instead of buying puts on IWM, I use SRTY. That is a 3 times leverage. Now, I really don't like 3x leverage on SPY, and I definitely don't like 3x leverage on the Qs. However, I don't mind it on IWM because it trades in channels. It goes up to the top of its channel, comes down to the bottom of its channel, bounces, goes back up, and just goes up and down, up and down. It's choppy like that. And it takes its sweet time, meaning the Russell or IWM, living within its own channel. So SRTY is a 3X, and it also has a dividend, and it pays it quarterly, which I find a lot better than, let's say, YQQQ. I'll get into the yield max one and why I dislike it. But SRTY, I think, is a great one for me for the Russell. When it gets to the top of its channel, I alert this in my membership group. I mean, if you're in my Discord or you're a member, you can see how many times through the list I've alerted SRTY when it gets to the top of its channel. 3x leverage, you get nice movement down when it comes down, and I sell it relatively quick. I take my profits, move on, wait for the Russell to get down to the bottom of its channel, then ride it back up. SRTY, put that one in your book to look at. Now, before I go any further, okay, I am not a financial advisor. I am not qualified to give financial advice. I'm just talking about what I use, and maybe it'll give somebody some idea, and you can do your due diligence and research it yourself. Okay, so SRTY for IWM. Another one I've used for S&P is SPDN. You know, S&P down, SPDN. Now this one's only a 1x, and the issue for me with the 1x is there's just not enough movement on the downside. If you're in a bull market and it's hitting, and SPY, let's say, is hitting a level of resistance, and you think, you know what, I think a pullback may come here, so I'm going to go ahead and work this fund. Well, it's only 1x, so you don't get a lot of movement down, and I want to capitalize on that movement down as quick and sharply as possible, and then get out as soon as I can, because I don't like to hold a short fund when the market is in a bull run. It just doesn't, it's not my risk profile. So I want to get out of that fund as quick as possible, make my money, wait for my next opportunity, and then maybe get in it again and again and again. But SPDN just doesn't move enough for me, but it looks like it's one of those you could hold for a while, but you would have to average down, continue at levels if it broke through. So SPDN, not my cup of tea, but some people may love it. Next, SDS. This is recent to me, like within the last month. The guy in a membership group, I was looking for something I could short the S&P with that was better than SPDN, that wasn't have as much leverage as some others, because I don't want a lot of leverage on a short fund when the market is in a bull run. I don't want that. SDS for me on, oh, and I forgot to tell you, SPDN has a dividend. I got paid a dividend from it, and it's nice, right? And the good thing about having a dividend with these is you don't have to actually get to your share price to make money. That, you know, as long as you get the dividend and the inverse fund is going up, you're in profit, you know, after you get paid your dividend. So, you know, depending on where your share price is, I'm probably confusing you here, but I like the dividend with these. It really helps not having to wait until the thing actually gets to my share price. I'm in profit when you get the dividend and it starts getting above that dividend price. It's great. I love it. It gives you flexibility to sell it whenever. Next, SDS. Like I said, this one is new to me, but I'm already in love with it. And it came from a guy in a membership group. I was looking for something that was a little more spicy than SPDN, but not as spicy as, let's say, SQQQ, which is 3x leverage. To me right now, SDS is my personal Goldilocks. It's a 2x. So that means it's 2 times. It's leveraged. So it'll move at 2 times the percentage daily of what the S&P moves. Okay, so if the S&P is down 1%, this should be up roughly 2%. How about that? So roughly, you know, it varies. So don't hold me on that number, but it's 2x, and it's wonderful because when the dip occurs, you can make a lot of money really quickly. And if it doesn't, and if the dip doesn't happen and it breaks through the resistance area, I can average down at another level, get my average cost lower, and then when a dip occurs, I can still make money because it moves at 2x. I love it. SDS right now is my go-to for the S&P. Last one I want to talk about is SQQQ. I've used this thing for years, but I don't really use it. Okay, so the last couple years, I haven't used it hardly any. Because it's a 3x, because we've been in a bull run, it just was too risky for me. to use SQQQ because it's a 3x. Now we're really getting some movement here, right? And like I said, when a market is in a bull run, I don't want that much leverage as far as 3x goes, but people love SQQ. They've held it for years. I mean, they will hold it for months, even though the website and the prospectus will say it's meant for one day. I have found, as long as I manage it properly, meaning averaging down at different resistance points, they work fine. It's not one of them things you can put one lump sum in and hope for the best. These are one of these things for maximum value and protection. They need to be managed, at least in my humble opinion. Now, lastly, if you've hung on this long, which is maybe one of you, who knows, right? Look, YQQ, so I'll be a little more candid here at the end here. I'm not a fan of that YQQQ. I don't know if it's Defiance or YieldMax, one of them. I've tried it a couple, 3 different times just to give it a fair shake. And the dividends coming out every month really mess with it. I really like the quarterly dividends, let's say in SRTY, SPDN, and SDS versus something like YQQQ. It cuts into the NAV too much. And it gets capped. It's like a YieldMax fund on the inverse where the doggone thing gets capped repeatedly. So if you get a monster down day and you're expecting something like that to happen, you get capped out. And that really sucks. So not a big fan of YQQQ. Not something I'm hopefully, you never want to talk in, never say ever or never or whatever, but I don't anticipate myself holding YQQQ ever again. But I'm a big fan of SRTY, big fan of SDS, and those are the 2 I mostly work. And I like using SDS even for the NASDAQ if need be, and just use the SPY chart for it, because they typically move, I know there's some variance between them, but they typically move in concert together, and they're both usually down together or both up together. Now, their percentages may be different or whatever as far as how much down or up they go, but as far as going down or up together, generally 99% of the time they are in concert together, meaning the NASDAQ and the S&P. Really long video. Sorry for that. Hope you enjoyed it. This is Mike, Tactical Stock Scalper, out.